Hello, today is Friday, August 5th, 2022. I'm Joe Schmidt from TC2, and this is Staying Connected. On today's podcast, I'm joined by Laura McDonald, a senior partner at LB3, and Tony Mangino, a fellow director at TC2. The three of us are going to talk about the recent slate of second quarter 2022 financial reporting by some of the big telcos and technology companies and what those reports mean for enterprise deals. The results tell a much different story from a few years ago and certainly from 8 to 10 years ago. Hey, Laura and Tony, thanks for joining me today. So, Tony, how about if you provide some insight?
Hey, thanks, Joe. Happy to be back and provide a brief summary. The end of July is always a busy reporting period, and you can learn a lot from reviewing the relevant reports. Two big earnings reports came out recently, one for AT&T and one for Verizon, and there were a few surprises.
Oh, really? So what's going on?
Well, neither company did as well as they had hoped, sharing some common weaknesses, but with varying performance in certain sectors. In short, both had weak second quarters, and both had declines in the wireline enterprise market. AT&T's business wireline revenues decreased from about $6 billion in second quarter 2021 to about $5.6 billion in the third quarter of 22. That's a decline of almost 7%. Verizon's total business revenues also dropped by about almost 2% year over year, and Verizon cut its expectations for its full year wireless service revenue growth after seeing weaker consumer wireless volumes. Not surprisingly, both Verizon and AT&T saw their stock prices go down after the earnings calls.
Okay, Laura, what do you make of all this?
Hey, Joe, it's great to be back with you. Well, first of all, you made a real good point earlier. It's important to take this into historical perspective. I've been doing this long enough to remember that when enterprise wireline spend was the driver, it was the lead story, it was a huge revenue generator, and that's obviously changing. Wireless is growing, and the business service revenue on the wireline side has dropped. For example, Morningstar says that for AT&T in the last 5 years, business service revenue has fallen to $24 billion in 2021 from $31 billion 5 years earlier, and that trend seems to be continuing. Verizon, as Tony pointed out, also posted what I'd call blah results on the consumer wireless side, adding far fewer subscribers than expected. But Verizon had much better results on the business wireless side, and most of that was driven by global enterprise performance. This is important to note because it's been estimated that 70 to 80% of Verizon's revenue is from the wireless side of the house now. And on the wireline side, it didn't do so well. It certainly didn't do as well as it hoped. During its earnings call, Verizon acknowledged that the business EBITDA was down 6.5% from the prior year.
Okay, guys, what do you think is driving the trend?
Well, Joe, it's a great question. The carriers claim it's due to inflation, increased access charges, technology change, and the impact of declining legacy business services. Each of the carriers have other items they mention, like AT&T's longer bill cycles, payment periods, Verizon's promotional costs. That's a pretty good assessment, at least regarding the technology change and declining legacy business services. Carriers have pushed enterprises to abandon POTS and PSTN services and move to broadband and edge services. Now, they've done this by raising rates, pulling services and such. AT&T's CEO John Sankey mentioned that AT&T still gets a fair amount of revenue from legacy services. But as customers replace these with cloud or wireless solutions, broadband, DIA from aggregators, it's hitting AT&T's bottom line. Case in point, both AT&T and Verizon have seen their legacy MPLS network revenues decline with this move we see to internet-first strategies and SD-WAN. This is an important point that we'll come back to a little later. There's also been an increase in labor costs. Carriers had to up the ante to keep folks out there during the pandemic, and those costs can really add up. Finally, we're seeing a blur between the services provided by these traditional telcos and the new entrants and cloud providers, the AWS, Googles, and Microsofts of the world.
So, Tony, that sounds a bit grim. I'm curious, Laura, is it all bad news for the carriers?
No, not all bad news. Obviously, Verizon and AT&T are putting as positive a spin as possible on things, even as they adjust or downgrade expectations. And, spin or not, AT&T had one of its best quarters for adding new postpaid wireless lines. And while Verizon didn't have the same results across its entire wireless sector, it had a pretty strong quarter for its enterprise wireless side of the house. These are really making the carriers focus on other areas. which is good for the enterprises as well. Verizon is touting its focus on network as a service as a capacity, fixed G access, and its C-band rollout. And it thinks that investments in those areas are going to be key for growth. AT&T is similarly focused on growing 5G and fiber. You also have to remember that these results have to be taken into perspective. Verizon and AT&T are still major players. Verizon retains the largest share of the wireless market with about 40% of the postpaid. AT&T and T-Mobile are duking it out right now, and actually T-Mobile's in the lead. Moreover, Verizon and AT&T are continuing to invest in spectrum and fixed line because those are needed for everything, including growing mobile and fixed networks. And you really can't underestimate Verizon and AT&T's inherent advantage because of their depth and expertise. Expert pundits point out that Verizon and AT&T are kind of uniquely positioned due to their global reach and technical capabilities, and that few others can really meet the complex networking needs of large customers. Now, both AT&T and Verizon have some pretty viable competitors. That assessment rings pretty true to me.
I think just generally there has to be growth. I'm stating the obvious. There's just wireless growth, right? There's growth in the wireless market.
You're absolutely right, Joe. Interestingly, it was T-Mobile that saw the most growth, the highest in its history. I think it claims that it added more lines than AT&T and Verizon combined. Now, that's going to be both consumer and business. And its stock, unlike AT&T and Verizon's, went up post its report. As I said, AT&T had a good quarter on wireless. Verizon had a good one in its global enterprise markets. And according to its earnings call, in that area, it had one of the best quarters since the start of 2020. And Verizon also points out it got a few marquee government clients in this area, like the FBI and the Virginia International Terminals for their 5G networks, which Verizon is touting as the gateway to mobile edge computing and delivering game-changing outcomes. So, there is good news in this, and you have to take it all in perspective.
All right. So, Tony, what does this mean for enterprise customers?
Finally, the $64,000 question, or perhaps with inflation, it's the $1 million question. There are things that enterprises need to watch for to best position themselves, Joe.
And what might that be?
Well, of course, the most important thing to do is keep close eye on the financial and commercial elements of your deal. We've seen decades of declining rates driven by competition, new technology, and savvy enterprise customers. This doesn't mean that rates are destined to go up, but it does mean the enterprises have to be extra diligent about maintaining their leverage and deal flexibility, particularly as it applies to commitments, meaningful rate reviews, and other key business impacting terms.
Tony, I agree 100%. And there's some things that enterprises really should watch for in light of the earnings reports that just came out. First of all, make sure you're looking at additional surcharges. That's one of the ways that rates can go up without it being quite as obvious. And this came up just recently when Verizon added its inflation surcharge. You also have to be aware of less competitive offers or other additional non-recurring charges that are slipping into the mix or being added to service guides and applying to your deals. Something else to watch for is a decline in support. One of the first places companies go to save money is to reduce overhead or to reduce headcount. And this may end up showing up in enterprise deals for delay in getting things done. They may be asking you to pay for support that you're already getting and hadn't paid for in the past, or forcing even more self-help on the enterprise. Tony, I think you mentioned you've seen some self-help to the extent of doing self-installations.
Yeah, that's a new one for me, but yes, we're seeing it in the marketplace.
Another thing to watch out is more aggressive billing terms or applications of late payment or finance. AT&T was the one who mentioned the problems with delayed payment. That's really more on the consumer side. And frankly, we've seen a lot of improvements on getting what are reasonable terms on the enterprise side, but we don't want to see slippage. So that's something to watch for. You always have to look for slow rolling credits. You'll see the carriers hold back the credits a little bit longer than they might have in the past. You need to watch for that. You might see a decline in promotions, particularly for devices or device subsidies. You already mentioned the issue with the rate review clauses, making sure you use them to your benefit. And they may be harder to get, meaningful ones going forward. They're already hard to get. And then finally, the carriers are always looking to make existing deals stickier. So it's harder for customers to leave. So you need to watch for those. Now, these are things that are not, as Tony pointed out, destined to happen. But there are things that everybody who are watching their deals should keep a careful eye on.
So what can enterprises do?
Well, as I said, you got to be vigilant and you need to be in a position to prevent slippage. So Maintain your leverage. That's always critical. Use RFPs and RFIs strategically. That helps with your leverage. Look at your needs in the mix of services and adjust or jettison services that don't make sense. Do you have half empty offices? Maybe you don't need all these expensive legacy PRIs. As long as you keep what you need for your 911 and other requirements, maybe there's things that you can skim on, particularly if the rates are going up. Don't give up on good staff augmentation provisions in your agreement. Remind your account team that they're good for them too. Make their jobs easier. Make sure that you pay your invoices on time so there's not a reason for people to impose late fees. And then watch very carefully for scope creep and amendments. So that you say if you're just changing or adding something and changing the rate, make sure that that doesn't expand to changing terms and conditions that you've already negotiated. And finally, don't assume it's all bad news. The turbulent market also makes carriers more eager to get new business, and they don't want to lose business. So this can work to savvy enterprises' advantages.
Yeah, Laura, when I say finding the opportunity in the chaos. So case in point, SD-WAN is driving enterprise migration away from expensive legacy WAN technologies, primarily MPLS, by leveraging lower cost internet-based transport for remote site connectivity and these internet-first strategies. Now, AT&T and Verizon are watching their revenues erode as enterprise customers look to internet aggregators to provide that connectivity that can be managed centrally by the SD-WAN solution, regardless of the actual provider of that access connection. Now, this dynamic helpfully exerts downward pricing pressure on legacy transport services. So, savvy enterprise customers can achieve significant cost savings on their legacy MPLS network spend as incumbent providers fight to halt or at least delay WAN technology migrations. Achieving cost reductions on the embedded base of legacy services provides savings sooner without the additional risk and complexity of circuit and service migrations.
Okay, good stuff. Thank you, Tony, and thank you as well, Laura. As you heard, it's crazy times in the ICT industry, so be prepared for some tough negotiations with your suppliers. We obviously can help, so feel free to contact Laura, Tony, me, or any of our LB3 and TC2 colleagues if you'd like to chat. You can drop us an email or just give us a call. You can also stay up to date by subscribing to these podcasts, by checking out our websites, and by following us on LinkedIn.